Welcome to this in-depth analysis of estate tax planning strategies for high net worth individuals, specifically focusing on those whose assets exceed the significant $15 million federal exemption threshold established for 2026. As the fiscal landscape continues to evolve, the recent passage of the One Big Beautiful Bill in July 2025 has fundamentally reshaped how the wealthiest families in the United States approach wealth preservation and legacy planning. For 2026, the federal estate and gift tax exemption has been elevated to $15 million per individual, which effectively means a married couple can shield up to $30 million from federal estate taxes. While this is a historically high figure for those with estates valued well beyond these limits, the 40% federal estate tax remains a formidable obstacle to intergenerational wealth transfer. In this guide, we will explore the most sophisticated tools available today to mitigate tax exposure and ensure that your hard-earned assets benefit your heirs rather than the Internal Revenue Service. The first and most foundational strategy in any high net worth estate plan is the proactive use of lifetime gifting. With the individual exemption now at $15 million, individuals have a unique opportunity to move significant assets out of their taxable estate while they are still living. By gifting assets today, you are not only removing the current value of those assets from your estate, but more importantly, you are removing all future appreciation on those assets as well. If you gift $10 million worth of stock today and it grows to $30 million by the time of your passing, that $20 million gain stays entirely outside of your taxable estate, potentially saving your heirs $8 million in taxes. In addition to the large lifetime exemption, you should always maximize the annual gift tax exclusion, which for 2026 stands at $19,000 per recipient. A married couple can give $38,000 annually to as many individuals as they wish without ever touching their lifetime exemption. Over a decade, a couple with 3 children and 6 grandchildren could move millions of dollars out of their estate through this simple, recurring strategy. One of the most popular and effective structural tools for married couples is the Spousal Lifetime Access Trust, or SLAT. A SLAT is an irrevocable trust where one spouse makes a gift of assets for the benefit of the other spouse and their children. Because the assets are in an irrevocable trust, they are removed from the grantor's taxable estate, yet the beneficiary spouse still has access to the trust's income and principal for needs related to health, education, maintenance, and support. This provides valuable safety net as it allows a couple to utilize their $15 million exemption today while still maintaining some indirect access to the funds if their financial circumstances change. It is a powerful way to lock in the current high exemption levels without completely losing the ability to benefit from the assets. For those with rapidly appreciating assets, such as pre-post stock or high-growth real estate, the Grantor Retained Annuity Trust, or GRAT, is an essential tool. In a GRAT, you transfer assets into a trust for a set term of years and receive an annuity payment back each year. The value of the gift for tax purposes is calculated using the WRS Section 7520 interest rate. If the assets in the GRAT grow faster than that modest interest rate, the excess growth passes to your beneficiaries completely free of gift and estate tax at the end of the term. This is often referred to as a successful estate freeze strategy because it allows you to pass on the upside of your investments without using up any of your precious $15 million lifetime exemption. Similarly, the Intentionally Defective Grantor Trust, or IT, offers the unique tax arbitrage opportunity. By selling assets to an IT in exchange for a promissory note, you can freeze the value of those assets in your estate at the value of the note. Because the trust is intentionally defective for Income tax purposes, you continue to pay the income taxes on the trust's earnings, which effectively allows you to make additional tax-free gifts to the trust by paying the government on its behalf. This further reduces the size of your taxable estate, while allowing the trust assets to grow unburdened by income taxes. Life insurance also plays a critical role in high net worth planning, but only if structured correctly through an irrevocable life insurance trust or ILIT. If you own a life insurance policy in your own name, the death benefit is included in your taxable estate and could be subject to the 40% tax. By having an ILIT-owned policy, the entire death benefit can pass to your heirs tax-free, providing the necessary liquidity to pay any remaining estate taxes without forcing the sale of illiquid family businesses or real estate holdings. For families looking to build a multi-generational legacy, the Dynasty Trust is a cornerstone strategy. By utilizing your generation skipping transfer tax exemption, which also stands at $15 million in 2026, you can fund a trust that lasts for several generations. Because the assets remain in the trust, they are not subject to estate tax when your children or grandchildren pass away, allowing the wealth to compound and support your descendants for a century or more while being shielded from creditors and divorce settlements. We must also consider the role of charitable giving in estate planning. The Charitable Remainder Trust, or CRT, allows you to donate assets to trust, receive an immediate income tax deduction, and take an income stream for life, with the remainder going to your favorite charity. Conversely, a charitable-led trust, or CLT, pays an income stream to a charity for a set period, with the remaining assets going to your heirs at a significantly reduced gift tax cost. These tools allow you to align your financial goals with your philanthropic values while minimizing the tax burden on your family. Another sophisticated technique involves the use of valuation discounts through family limited partnerships or limited liability companies. By placing assets like real estate or a family business into a fund, you can gift minority interests to your heirs. Because these minority interests lack control and marketability, their value for gift tax purposes can often be discounted by 25 to 35%. This allows you to leverage your $15 million exemption even further, effectively moving $20 million worth of assets out of your estate while only reporting a $15 million